A home equity reverse mortgage, or a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older, and it does have some unique features that make the HECM a valuable tool in retirement planning and aging in place. Why should you consider a HECM versus a home equity line of credit or a HELOC? Well, hopefully this video will help you decide. Let's compare the features of the HECM to a forward mortgage or a home equity line of credit. There are quite a few of them, some more important than others, so we shall only discuss the major ones. And bear in mind that a reverse mortgage will generally cost more than a forward mortgage or a home equity line of credit. The first big difference is that very low income qualifications are required for a HECM. Most forward mortgages will require that you have 4 times the principal and interest payment in monthly income. The HECM only requires that you meet the minimum residual income under the Department of Veteran Affairs minimum residual income tables. The next big difference in features is that the HECM provides an age-in-place protection. This protection allows you to remain in your home provided you stay current on your property charges for as long as you live in the home. The other big feature of the HECM is that there are no deficits upon sale if the home is worth less than the balance of the mortgage. It is a non-recourse loan. Many states do allow non-recourse mortgages on the original purchase transaction. However, you generally lose that protection if it is a refinance mortgage or a second mortgage like a home equity line of credit. Another useful feature of the HECM is that its line of credit, if unused, will grow over time, reflecting a minimum anticipated appreciation in the property, as well as the release of interest reserves not required as your remaining life gets shorter. This feature is especially unique to the HECM. And of course, with any reverse mortgage, you have the option to make or not make a monthly repayment and not have your credit score impacted in any way. Finally, a feature that many people are not familiar with. HELOCs generally stop you having a draw after 10 years so that you can start to repay the principal you borrowed. What many people do not know is that if the bank thinks you are unable, due to a loss of income or conceivably due to a substantial drop in property values, to repay the HECM, they can restrict your access to those funds. This is not true with the HECM, unless you are in default. Generally, being in default here means you have not paid your property charges on time. Your access to funds are insured by the federal government under the HECM program, even if your home value already is under your available line of credit in the HECM program. So you can see in the many features that we've discussed here that the HECM offers a consumer a great array of protection and security. Take a look at this example. Note that in years 1 to 10, we made the draw and the interest paid on the HELOC and the draw and the origination costs the exact same for both the HELOC and the HECM. Both amounted to $240,000 or $20,000 a month. We did that so that we could get an exact comparison between the payment patterns and what they result in when you look at the both products separately. Because of the growth of the unused HECM line of credit at the end of year 10 under these circumstances, the HECM had an additional line of credit of $102,000. It could have all been drawn down in the next day if you wanted, but we decided to spread it out. And as a result of spreading it out, the unused portion also grew in the years between 11 and year 20. In the end, we managed to extract $136,500 in extra draws as a result of the growth in the credit line. The HECM has this unusual feature, and it certainly helps borrowers when they need it. The HELOC does not have a similar type feature. We also assume the interest on the HELOC is paid out of the HELOC line of credit, so that the borrower really only has access to free cash and a net amount of $186,157. The repayments are essentially zero for the HELOC. However, the borrower doesn't get his hands on the interest that he had to pay. Also, due to that HECM growth, if you do use it, and the HELOC's interest payments in the first 10 years, the HECM had available a line of credit to the borrower of $371,500 in total over all the years versus $186,157 of the HELOC. Bear in mind, we're still talking about the same appraised value on the same home with people at the same age. So this is truly a like-to-like comparison. So when you look at this, you say, why is the balance owed so large at the end of 20 years on the HECM compared to the HELOC? There's an actual difference of $577,000. Well, basically it's because of maybe three primary things. One is, on the HECM, you were actually allowed to borrow an extra $185,000, no small sum of money. In addition, you were forced to make cash repayments on the HELOC in the last 20 years of the HELOC's life, but in this case we're looking at just 10 years. But those repayments were another $193,000. That's a total of, $378,000 that are principal transactions. You don't have to do them, or if you're forced to do them, they're nothing to do with the cost. Now the interest costs, however, are costs. And those interest costs here, the $123,000, is in fact the interest cost on the extra borrowed money of the $185,000 and the fact that we did not make repayments on the HECM of $193,000 as we did on the HELOC. That $123,000 is the interest costs on those transactions spread out over the 20 years we're looking at. And then finally, there's mortgage insurance. Now, the mortgage insurance is absolutely an extra cost of doing business with the HECM. However, the one thing you need to understand is that your mortgage insurance costs are actually unknown until the HECM is paid off. Any deficit on the value of the home, less the amount owed, is an offset to this cost. If you sell your home and you have a deficit of $100,000 and you do not owe it, you paid $71,000 for the opportunity to participate in not being charged that deficit. So in fact, you were ahead $30,000 on mortgage insurance. So again, I hope this little analysis helps. It's not an easy product to compare, but I think you will agree that the HECM gives you a great deal more choice. Yes, it will cost you more, there's no question, and if you don't make payments, the interest on the interest will certainly mount up fast. On the other hand, isn't it better to have options? Isn't it better to have choices than find yourself with a monthly repayment plan on a home equity line of credit that you possibly cannot meet? And let's be clear, if you cannot meet it, you will lose your home to foreclosure if eventually the borrower cannot come up with the money and pay off the loan. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.